Okay, I'm assuming everyone can hear me and see my presentation. So I thought we would look at, since the board has just approved the 2020 audit, I thought you'd want to see real quick just the financial position of the pool. So right now, up on your screen is the balance sheet, which is the statement of net position. Just going through this, cash and cash equivalents at 14 million. That does include cash held to be reinvested with Zion's Wealth Advisors. Short-term investments with Zion's Wealth Advisors are those investments that are shorter than 1 year before they mature. Prepaid expenses, that is an amount that we do a prepaid to our reinsurance carrier. We have the property program renews on a July 1, and so those are prepaid expenses up to July 1. Our long-term investments are also with Zion's Wealth Advisors up to 5 years based on the Money Management Act. Capital contributions that we have at 3.5 million. These are contributions into our reinsurance provider that is equity that we have in reinsurance. Property and equipment is the assets owned by the pool, and that is including land. And then our deferred outflows is required by URS. So we have those booked. So our total assets are at 20.5 million. Our liabilities, the reserves for losses and loss adjustment expenses, those are what our actuarial has provided us during their analysis of all the losses for the pool. And those are booked at an expected level, which is about a 66% confidence level. Accrued expenses are the accrued sick and vacation. And then contributions paid in advance, those are our unearned contributions not unearned, but contributions that were paid in 2020 that were actually for 2020, the 2021 program. Also related to pensions, our unrestricted account does include a rate stabilization fund that the board has approved at 200,000. Also a claims deterioration fund at 660,000 is listed in that unrestricted. So are there any questions on this first balance sheet? I can't see the chat, so if there is any, someone just chime in. The next exhibit is our income statement. So this shows you what the contributions were collected in 2020, our investment income, and also other income, which is anything we receive from sponsorships for our membership meeting, things like that. Loss and loss adjustment expenses, a little bit over budget. The board did have to approve additional funds for losses. It was at 3.5 million. It had to be increased because we did go over budget last year on loss and loss adjustment expenses. So those are paid claims for 2020 at 3.89. Our reinsurance coverage is at 1.9, or was at 1.9 in 2020. And then we go into our administrative expenses for the board of directors, any depreciation, our risk management charges. A lot of that includes our local GovU, any travel for training go under risk management. Public relations, we didn't really do a lot because there wasn't a lot of conferences to go to. Usually those funds are used to help UAC at their conferences. Our office expenses, those are IT costs, and also costs that we pay for utilities as part of our lease agreement with UAC. Also computers, equipment, any staff travel, postage, supplies, printing, things like that. The financial and professional is our actuarial costs, our appraisal costs, and our audit costs. And then the personnel is our staff salaries and benefits. So we had a total administrative expenses at just over 1 million. Let's see, so our change in net position, oh, actually, let me go to this 167,000. That is the equity that we gained in CRL last year. So that's the equity increase. So our total change in net position for 2020 was 408,000. The total net position is 9.2. Any questions on that? You'll have to just chime in, like I said before. So to do a historical kind of snapshot for the last 5 years, based on audited financials, just want to have this exhibit for you. So it just combines all the income, which includes the investment income, the underwriting expenses, which is the paid losses and reinsurance costs, and then our administrative expenses. So you can see how those have either increased or decreased over the years, mainly in this underwriting expense line. You can see that these increases and decreases pretty much play out on what has been paid out for losses. So 2017 wasn't that great of a loss year, as well as 2020. We've had our largest paid out loss year in 2020. But you'll see that the net position continues to increase, which is part of a plan that the board has that I'll speak about in just a minute. To chart those out, also I wanted to show you this exhibit for those 5 years to show you where in 2016, you know, especially this net position line and underwriting line, we really don't want to see a lot of crossover, including the income line, except for net position. This was a good crossover. But I felt like this was a good exhibit to show you that income and expense compared to the net position. So if you keep that in mind, in 2016, the board was a little bit concerned about those lines getting too close to each other, the income and expense. So they adopted in 2016 a net asset management policy. And the purpose of this policy is stated below: to manage net asset levels, to assure adequate assets, to protect UCIP's financial position without holding excessive public funds as net assets. And there is a procedure in place that the board manages, that net assets should not exceed 250%, and it should not fall below 50% of annual contributions. So if we look at that charted for the last 5 years, you'll see again here in 2016, the contributions at 100%, which is the green line, and net position, these two lines were getting fairly close. We weren't to the more orange line, which is a 50% of contributions, but it was getting close. And so that was a concern of the board. And so that's why they adopted that policy. So as part of a plan over the next 4 years after 2016 audited financials, we're getting close together on these lines. The board adopted a restructure of the contributions rates. So they did a rating restructure to fall more in line with CRL's rating structure, our reinsurance carrier. And I'll go through those rates in just a minute. But they put in place that plan, and you can see it was a slight increase each year for 3 years is what they put in place. So that's why you see this green line gradually going up, and it ended in 2019 for that 3-year plan. Now that we have the new rating structure in place, now the new from 2019 to 2020, including 21 and the same in 2020, they'll use that same rating structure, which should bring in line all of the members based on their exposure to be paying their fair share. Any questions about this exhibit? I do want to note as well, you'll see the net position is continually growing, which is good. That was the plan of the board from 2016 to adopt the new rating structure. And because we had a couple of good loss years, especially 2019, that net position increased. Just to show you or tell you about the difference, in 2019, our net position growth was 2.2 million. So due to losses paid, that net position, as you recall, for 2020 was at 408,000. So if we go into rating now, you'll see what the board looks at as far, and I've put the 2020 exhibit on here because we didn't have a risk coordinator workshop last year. So I thought I'd show you a comparison from the 2020 rates to the 2021 rates. So this first exhibit shows the 2020 rates and what the board had approved. First, they look at the rates that the actuary provides to the board based on the different lines of coverage. So law enforcement, public officials, general liability, automobile liability, and property. So this first line, as you'll see in green, is what the actuarial indicated rates were to the board. She felt like we needed $1,700 to pay for full-time law enforcement officers and those losses. And I should say, and administrative expenses. So these are the rates. So what the board does, they also look at their rates from the prior year to see if there's any huge swings so that we can keep those rates pretty much stable. And this last year, Johnny presented very well how the rates that the board approved compared historically to the rates that the actuarial provided. So we're getting pretty close to what the actuary is requiring or saying is a representation of what should be listed for the rates. So you can see what actually the board approved. They didn't want to go quite as high as this. This would have, you know, caused quite a bit of increase to members. So they did kind of an in between in 2020 for their rates. But you can see how these rates that were approved compare to what the actuary provided as anticipated rates. Our reinsurance carrier also covers crime, cyber, defense, terrorism costs, and drones. So we do have to rate for those items for our $250,000 layer. And so these are based on premium costs with CRL. So you can see our total estimated contribution that the board reviewed was around 7 million. So if we compare that to 2021, these are the rates you're seeing this year. We did go up to the rate for law enforcement because of that large exposure. So we did include or did adopt, the board adopted that rate for law enforcement. Public officials rating is going up. We didn't quite think we should go up to that 280. So we compromised with a 250 rate per full-time employees. So this is full-time law enforcement employees. So you can see how those are, the exposure that those are rated on. Is there any questions? Okay. So I just wanted to give you a comparison visually. So these are the increase or decrease in the rates from the prior year, meaning from 2019, from 2020 to 2021 rates. So law enforcement did go up $75 per law enforcement officer. Public officials, even though we didn't go quite as high as what the actuaries recommended, it still was a 57% increase from the prior year, $57 per full-time official or employee of the county. General liability did go down $12. Automobile liability went down. Property for earthquake counties and non-earthquake counties, those are the differences in those dollar values and then percent change. Okay, is there any questions on rating for our program for the, okay, hopefully we've got a few people still with us. So let's go into the workers' comp rates. I wanted to just show you a couple of exhibits for workers' comp, even though everyone that's listening in may not have workers' comp with UCIP, but I just want to chart out what their rates had changed or how the rates had changed. Charlene, do you have a question? You showed me your video, so I wondered if you had a question.
No, I was just confirming that there are people still here.
Okay. Thank you very much. All right, so rating increases or decreases, I should say, over the last 6 years with WCF. I thought this was interesting a little bit, and I'll go into this a little bit more. But as far as firefighters and firefighter volunteers, WCF has been using pretty much the same rate until 2020. Now in 2021, they've rated those differently for the volunteers. And Johnny touched on this a little bit about how the firefighters, if you haven't tracked their hours, WCF is using a base rate for that. And here's how they are doing that basis calculation for firefighters. And so Johnny touched on this item right here. If hours aren't tracked, then they're just going to charge $1,000 per volunteer. And one of our smaller districts is in that situation where when we got the audit back, it was, quite a bit of increase for that small district. And it was because of this. They hadn't tracked the hours for those firefighters. And so WCF had to use that $1,000 per volunteer. So it is probably worth taking the time to do that as well. Johnny, did you want to touch on anything more on that, or that's pretty much self-explanatory, I guess, on this? We encourage you to try to track those.
I just think it's worthwhile that if you have a lot of volunteers, that rarely work or spend few hours, it's probably worth your time to track their hours and pay less in workers' compensation. But it'd be worth your time, I think, at least once every couple of years to take a look at that and determine if I would have tracked the hours based on what I think the hours are, would have I paid less in workers' compensation than the $1,000 base amount? And if so, then again, whether or not it's worth the time and effort to actually track those hours and turn those into workers' comp. But if they end up being pretty close to, it would have came out to about $1,000 per volunteer anyway, then wouldn't be worth your time and effort to track the hours. So.
Okay. Also, I just wanted to show you a couple of exhibits based on the 2020 audit that was just performed. So you can see this exhibit is showing the percent change in audited payroll. This big swing in 2015, this was due to an addition of a fairly large member to the program with UCIP. So, but as you look at these different values, I mean, it's looking between a 3 to 7% increase each year. So the estimated payroll, based to the audited, this kind of shows you change, or actually, I'm sorry, it's not estimated. This is just change from year to year for payroll. So those increases year to year from the audited payroll is about a 3 to 7%. So that's a pretty good exhibit. But I did want to show you this. So after the audit came out in 2020, WCF provided this exhibit. So they have our 2021 estimated numbers. So they compared those estimated numbers to what the final audit was in 2020. So you can see already basing that, we're at 18.9 million underestimation in payroll. So what we recommend is when you are reporting those payroll numbers, you go back and look at your 2020 audit, what your actual is as of June 1st, do a half year, and then try to estimate any type of maybe COLA increase or staffing increases to help you get a little bit closer to the actual amount of payroll that's been reported. So that'll help you in the end. I mean, some counties, they may like to get a check from WCF or an invoice from WCF, or from us, but based on those audited numbers. So it's, you know, it's how you want to do that, but we recommend that you try to estimate in June when you report those numbers to Marty, that it's based more on those three criteria, looking at what was audited, your current at 6 months, and then if you anticipate any type of increases for staff and COLA. And then that'll get you close to those numbers. Johnny?
I was just going to say, Sonya, that if you've traditionally had a pretty significant audit amount to pay, or you get a pretty significant amount back every year when the audit occurs, that might be a worthwhile discussion to have with your auditor or finance director to see what their preference is. Again, like Sonya said, some auditors prefer to overestimate the payroll and get a check back rather than owing money that wasn't budgeted in the next year. And some, you know, prefer, well, we're okay with paying on audit, because more or less what UCIP has done is they've borrowed us that money interest-free for the year, and we are paying our premium a year later than we really should have. So again, it's a financial question that you might want to have with your auditor or finance director.
Okay, now I can see questions if there's any questions, but that's pretty much my report.